Good morning and welcome to the webinar that is an introduction to Rivington. Let's begin our introduction to Rivington with a very brief update on the strategy changes at WHV and give you a little intro to why we're doing what we're doing. The current manager of the WHV International Equity and Global Equity Strategies, Dick Hirayama, is retiring. Rivington, which is a specialized investment group inside WHV that manages global and international equity, will take over the management of that strategy in the coming months. We're going to be able to customize that transition to your investment management agreements and your circumstances during that transition, and we'll come back and be able to address that with representatives later. The Rivington team has worked together as a cohesive group for the past 10 years, managing significant institutional assets at both Victory Capital and Deutsche Asset Management prior to joining WHV. Their focus is on managing portfolios of high conviction ideas using rigorous bottom-up fundamental stock selection. Over time, their disciplined life cycle-based approach to investing has consistently generated excess returns for investors while preserving investor capital in challenging markets. We're really excited to have the Rivington team with us, and with that brief introduction, I'd like to give the floor over to Matthias Kner to talk to you about the Rivington process. Matthias.
Hi, everybody. For those of you who don't know me, this is Matthias Kner. I'm Senior Portfolio Manager with Rivington with 20 years of experience as an analyst and portfolio manager. Most recently, I was the CIO of International and Global Equities at Victory Capital, and prior to that, I worked at Deutsche Asset Management for over a decade in a number of roles, including as Head of International Equities and Lead Portfolio Manager of the DWS International and DWS International Select Equity Strategies.
Hi, this is Chris Lagenet. I'm one of the portfolio managers at Rivington. I started my career in 1997 at Scudder Kemper, and I have been in developed and emerging international markets my entire time. I spent a few years there, then was at Oaktree Capital for a number of years on their emerging markets hedge fund, traveling the globe, and then moved on to Morgan Stanley, where I ran a global resources long-short fund. After that is when I met Matthias and joined about 10 years ago in 2005, and I've been with the team ever since.
Hi, this is Andy Manton. I started my career as an analyst at Merrill Lynch before going back to graduate school. I attended Carnegie Mellon University's MBA program, and from there I joined Deutsche Bank Asset Management in their quantitative strategies group as a research analyst. I met Matthias in 2008 while I was at Deutsche Bank, and after learning more about the work that he and Chris were doing on this strategy, I decided to join their team. We left Deutsche Bank for Victory Capital as a team not long after that, where we continued to develop much of the process that we use today. I'm responsible for the quantitative aspects of our process, and on the fundamental side, I cover the maturity and the distress life cycle stages for the team. So turning to the next slide, I'll hand it back to Matthias, who's going to walk us through the philosophy behind our process.
The company generates value for its shareholders by successfully redeploying capital over time. To measure a company's ability to invest its capital on behalf of its shareholders, we have a distinctive life cycle approach to investing. Three hallmarks of our strategy are a concentrated portfolio with active share, creating the potential for significant alpha, a repeatable, consistent investment process generating excess returns, and disciplined active risk management for limiting volatility and offering downside protection for potential in challenging markets. Here on slide 6, we show the investment life cycle and our approach. The company's progress, prospects, and return on capital change as it progresses from innovation to expansion, deceleration, maturity, and distress. And we believe as investors, their approach also needs to change as the company develops. Ultimately, we're measuring a company's ability to redeploy capital and trying to determine whether that ability is mispriced or not by the market. I cover the companies following the first two stages of the life cycle, innovation and expansion. In innovation, these companies are the highest investment phase, and they're earning low but improving returns, reflecting their early stage of development. Innovation is the smallest life cycle stage, totaling less than 5% of the total universe. And these are typically high-risk investments with a wide range of outcomes. The goal for any innovation investment is to advance into expansion by growing and improving returns. In expansion, these are your classic growth stocks. Historically, expansion has been the best performing life cycle stage. A great example of an expansion company is Starbucks. Although it probably feels like there's a Starbucks on every corner already, it continues to innovate through new products and new categories. They've expanded obviously from drinks to food, but also later in the day, increasingly into new geographies. And all the time they're improving their profit margins and return on capital by increasing store productivity through higher ticket sizes, increasing sales per square footage, and more frequent customer visits. This is a good example of what I'm looking for when I'm speaking to management on companies during this stage of development.
Hi, it's Chris again. I covered the deceleration life cycle. This is a pretty large life cycle. It's about a third of the global investment universe. And what it means is that these are companies that have passed their peak returns on invested capital, but are still earning very healthy returns. So what matters to a deceleration company is that it is able to generate good returns, take that, compound the asset base, and continue to grow. And successful deceleration companies can continue this on for decades as they continue to reinvent themselves. A good example of a deceleration company is Nike, which I'm sure all of you know. They've got 60% share of the U.S. athletic foot market, about 25% of the global market. And what makes them interesting is that they have been moving away from the wholesale model where they're selling to Foot Lockers and Sports Authority, and they're going directly to the consumer. If you have kids, you've probably seen that someone is on the website trying to design their own shoes. Nike has been reaching out directly to these consumers so they can capture that retail margin. That's been pretty material for them. They've had about a 500 basis point increase in margins since 1998, and that compounded with growth in emerging markets, particularly in China with basketball, and moving into clothing, athleisure, and then combining that with the with reaching out to the consumer. It's a really successful story. Now, eventually, returns get competed away as other entrants come in, and those returns start to fade, and then we start to head off into the next phase, which is maturity.
Hi again, this is Andy. I cover the last two stages in the life cycle, maturity and distress. For maturity companies, these companies' competitive advantages are usually fading away by now, and they may or may not be growing at this point. And usually if they are, it's pretty slow. Balance sheets are usually not a problem, and in fact, the biggest question these companies have to answer is what to do with their cash flow and excess capital. The biggest risk in this group is that competition or some other change in demand continues to cause margins to deteriorate, and the companies fall into the distress stage. This is especially risky if this is happening at a time when the company is returning capital to shareholders, so I have to pay close attention to that. Examples of types of companies that are currently in the maturity stage include JP Morgan, Boeing, and Kroger. For distress, I look for very different things. For these companies, business as it is just not sustainable. So I look at several different things, including the likelihood that there might be a change in management if there hasn't been one already, what the current plans for restructuring or reorganization look like now, or should there be a complete change in the business plan. The managements have to be very skilled at turning around companies, and so discussions with them are critical to understand what their plans are. We're starting to see a lot of resource and commodity-based companies in distress right now, such as Rio Tinto, Anglo American, Tech Resources, which is a coal company in Canada. Steel-related names like ArcelorMittal have been in this stage for a long time. Some other names that you what you wouldn't typically expect to see in distress are Airbus and Hewlett-Packard. Those have both been in distress for quite a while now. We know from backtesting and our real experience looking at these companies for the past 8 years that picking a winner from this group is by far the most difficult of any of the stages. The hit rates or the percentage of companies that outperform is very low in this group, even for the companies that are ranked in the top 20% section of the screen. So as a result, I usually, on any given year, I recommend about 1 out of every 15 to 20 names that I look at from distress. The risks are extremely high here, but the returns can be huge if you get it right. And actually, some of our biggest alpha has been from names that we found in this group. So on to the next slide, Chris will walk us through an example of how the life cycle methodology can be applied to a whole industry.
All right, so what we have here is a set of companies that a global consumer discretionary analyst may be looking at. There's a few in the US that you recognize, and then on the right you'll see that this is how we look at the world. So in innovation you have fast retailing, which sells Uniqlo under its own brand, and then Under Armour, Nike, Target, and JCPenney, which are all based in the US. So even though a consumer discretionary analyst may look at this as, they all sell apparel and consumer goods to consumers, that's really where the comparison ends. If you look at the business models of all of these companies, you'll find that they're vastly different. Nike we discussed earlier, but if you look at, say, fast retailing, which is based in Japan, and Target, these business models are completely different. So Target, which I think you're probably more familiar with, like many large retailers, they're struggling with growth. They're looking for ways to drive traffic into their own stores, tie-ins with exclusive designers, selling off unprofitable businesses like their pharmacy business at CVS, which was just announced. They're looking to introduce a grocery concept into the store and expanding their omni-channel, which is actually all retailers are looking to do, like have your web presence tied into the stores. So what they're trying to do really is just drive foot traffic and not grow and keep their margins up. So that is really some of the hallmarks of a mature business, of a mature company. Fast retail on the other side, all they're caring about now is expansion. What they do is a little bit different. They target younger generation, very fast fashion, sort of disposable fashion, if you will. Very high inventory turns at a cheap price that really, prey on sort of impulse buying. But for them, profitability matters less. They're really just trying to grow, expand to China, the US, and throughout the rest of Asia. That's been their target. Margins have been suffering as a result of both some weather and also them just really driving the expansion. But what they're looking to do is keep increasing their footprint, and then eventually move into dominating in the US and in Europe. So as they continue to do that, they will, if they're successful, will eventually move into expansion and then deceleration down the life cycle. On the next slide, 8 really kind of runs through our investment process, and Matthias and Andy will run through that for you.
Just quickly want to remind people, if you have any questions, you can type them into the chat question box on your screen throughout, and we will make sure to get to them at the end of the call. Here on slide 8, we have a depiction of our investment process, and there are really 3 discrete steps in the investment process. A life cycle screen, step 2, stock selection, and step 3, portfolio construction. At the start, we use a life cycle screen to narrow our broad universe of over 3,000 companies down to a select portfolio of 35 to 45 stocks. The screen simply ranks and scores the universe. But it's a little complicated. In a minute, I'm going to ask Andy to go through in a bit more detail for everyone. The second step is stock selection, and we really are a team of stock pickers. We're spending 90% of our time going through companies one by one and analyzing their business models. We start with the basics. What does this company do? Does it do it better? What are its opportunities to grow, to reinvest? What are their major challenges? How are they going to improve their profitability? How are they going to improve their deployment of capital? We make sure to speak to management to discuss with them our expectations and our views on where they are in terms of the development of life cycle. We do our own analysis. We have our own proprietary discounted cash flow model with financial statements, and we construct our own investment thesis for every investment opportunity that we're looking to do. Lastly, we use an optimizer to assist us in constructing our portfolios to maximize expected return while thoughtfully managing portfolio risk.
Hi, this is Andy again. So going back to step one, I'll take you through the screening process in a little bit more detail. The screen itself can be thought of in two different steps. In the first step, we have to reclassify each company in our investment universe into one of the 5 different life cycle stages. In doing this, the model itself quantitatively normalizes the financial statements for each company to account for the various accounting differences around the world, and also to determine the real cash flows and the real asset bases that might otherwise be distorted by various accounting methods and different ways companies use their balance sheets. So we really want to be able to compare companies on a like-for-like basis. So once it does that, the screen then goes through a series of if-then statements, essentially, to determine where each company falls along the life cycle spectrum using their real cash flows and their real asset growth rates. The second step is then to apply a model to the companies. Unlike some of the other basic screening processes where companies are sorted and then eliminated according to some basic fundamental metrics, we use a more rigorous system that takes advantage of the unique qualities associated with the different life cycle stages. So we use a multi-factor model that applies different factors and different factor weights to companies depending on which life cycle stage that they are in. These factors can be thought of as being rolled up into what we refer to as 3 super factors, which we refer to as valuation, quality, and momentum. I keep a library of about 60 to 70 different factors right now, which I regularly test for their effectiveness at predicting the returns within the different stages. And in general, I look for factors whose predictive ability is very slow to decay. Ultimately, we want a model that fits our longer-term investment approach as closely as possible. So in practice, we've found that each stage is affected by a very different group of factors, which we suspected at the onset of this. But for example, deceleration and distress, actually, when you look at them from the super factor overview, they have similar weights in valuation, quality, and momentum. But when you look at the underlying factors that are in each, they are actually very different. The quality factors, for example, in deceleration, tend to focus on cash flows and working capital use, while the distressed companies are better forecasted using factors that measure shareholder equity, stability, and things like that. And for the valuation portion, cash flow yield tends to drive deceleration names, while the more basic metrics like price to book work a bit better for distressed. So the model then scores and ranks each company. And our research has shown that the top 20% of the ranked universe consistently outperforms the benchmark in both up and down markets. So we use that top 20%, or the first quintile, as our narrowed list of companies to focus on for our fundamental analysis. So this is all done, behind the scenes, if you will. I rerun the screen each weekend so that when we walk in on Monday, we have an updated list of companies to prioritize our week around. And this is again done to make this as effective as analysts and portfolio managers as possible. The screen is just a tool that we use to get us to the best possible starting point so that we can go to work on our fundamental analysis where we do spend most of our time.
Here on slide 9, we have a summary of the team's investment performance. The strategy really targets to achieve excess return of 2 to 4% per annum. And as you can see in the top bar chart, that's exactly what we've delivered over the past 7 years here since inception. That's not to say that having a disciplined approach doesn't mean that you don't have the opportunity for significant excess returns. you look at 2010 and 2013, for example, we've had years of over 800 and 600 basis points of annualized alpha. But just as importantly, even in our worst year, we've only lost 180 basis points relative. This is the kind of payoff structure that we think is critical for investors, protecting them on the downside, but allowing them to more than fully participate on the upside when markets are strong. Finally, just to summarize, our life cycle investment approach to international investing is going to deliver a concentrated portfolio with high active share, creating the potential for significant alpha, a consistent and repeatable investment process generating excess return, includes disciplined active risk management, limiting volatility, and offering downside protection potential in challenging markets. I want to thank you for your time today. We hope to have the opportunity to work with you in the future. Now, going forward, we'll take any of your questions that you might have, and please remember to use the chat text box that you have in front of you.
Thanks, guys. Thanks a lot. So we have a few questions coming in, and so one of those questions is, are you guys really a growth manager, or are you more of a core manager?
This is definitely a growth-oriented strategy. We emphasize asset and equity growth in our life cycle analysis and in our classification. And then we combine that with some disciplined risk management. But at its most basic level, life cycle analysis is about the company's growth and return prospects and how they're able to compound that over time.
Great, thanks, Matthias. You know, the modeling work that you guys are doing that Andy described is really complete and impressive sounding. Are you guys a quant manager?
No, we are definitely fundamental managers. We're stock pickers as a team. The quantitative aspects of our process are simply tools that help us get to a better starting point and to improve our productivity. And I like to think of it as, it's like having a calculator. You wouldn't do the math without one, and this is the same sort of thing. These are tools that are going to help us more quickly come to our answers.
Great, thank you. There's a question here about the track record going back to 2009. Where's the rest of the team going back to 2004?
So the team started at Deutsche in 2004. When we moved to Victory Capital, there was a 3-month period where I had what's called garden leave, and KeyBank, which is the parent company of Victory Capital, had a private portfolio which was used to transition. We don't have that data because it was kept at KeyBank, and Victory is no longer part of KeyBank, and therefore, just for GIPS reasons, we're not allowed to port the entire track record back to 2004. So that's why the starting point is January 1 of 2009. It's more a technical issue than anything else.
Given the portfolios that we're trying to transition, one thing that people are noting is, what are your guys' current thoughts on energy, and do you intend to keep an overweight to that sector compared to the Hirayama sub-advised portfolios?
Yeah, this is Andy. I'll take that one. Yeah, in general, I'd say we're very concerned about the energy industry as a whole right now, with oil sitting at 12-year lows. We think that the oversupply problem is very real, with inventories at storage facilities around the world basically at record highs. But this is not a new problem. I think that when you start to look at the supply and demand balance, you know, going back to early 2014, there's just been more supply, more productivity, or more production than actual demand. So it's been slowly building, but kind of really coming to a head right now that we're seeing a lot of headlines about it, and certainly the biggest headline is the price of oil. So very concerned. We think that this is going to take quite a while to work itself out. There's a whole lot of different players in the market, the biggest one being Saudi Arabia, and they are just determined not to repeat what happened in the 80s when they lost market share and lost a lot of face doing that. I think it's, in the U.S. it's kind of a unique problem as well, that a lot of the production here is by smaller and medium-sized players. A lot of them are still hedged, and so they're still pumping as much as they can to produce cash flow as well they can. So it's not going to be until those hedges roll off that they can actually, start to see some real deterioration in their cash flows. But ultimately, I think there's going to be a lot of bankruptcies in the industry. There's going to be a lot of consolidation, and until that really happens, I don't think we're going to get too constructive on the industry. So last year we were pretty underweight energy, and we were when oil started to consolidate around 40 at the end of the beginning of last quarter, we started to close the gap. But we'll just kind of wait and see what happens now. But generally, still concerned.
Great, thanks, Andy. Another question that's coming across here is, what are the current allocations to the life cycle stages, and do you guys target those? Do you have target allocations to those, or does or how does that vary over time?
So we do not have targeted allocations by life cycle. We've done a lot of analysis on that, and you can think of it as life cycle is a factor which helps you identify winning companies, so an alpha factor. But in terms of risk factors, it's less important, and therefore constraining that is actually not very value added. And we actually spent quite a long time back at the Deutsche days testing that, and came to that conclusion early on, that things like sector, region, style, interest rate, currencies, these are the systematic factors that you want to constrain through a portfolio construction process. Life cycle is something that you want to actually actively express through your stock selection. Our current weights are, we are overweight in expansion, and we are underweight actually in distress, deceleration, maturity, and innovation. So all of that is currently actively overweight in expansion. And I think, as I mentioned earlier on, we have a lot of data to support that expansion as a whole over the long term has been the best performing life cycle stage. Second best performing is deceleration, and that is actually our second largest weight as well.
Will have a 10-second heads up.
Great, thank you, Matthias. So I presume in this context that overweight and underweight mean compared to the proportion of stocks that you would otherwise categorize in that life cycle. Is that right?
Yeah, so we, in the screening process, the first step of the screen is to reclassify the entire world into life cycle stages. So this is proprietary data for our team, but those allocations are what I'm referring to when I'm saying overweight versus underweight, similar to what many other managers might display by sector and by region.
Right, got it. Quick question kind of associated with that. What is the typical annual turnover for the strategy?
Turnover has come down somewhat, and more recently we've had turnover kind of at about 50 to 70% of the portfolio per annum has been the amount.
Great, thank you. Can you, one of the questions that's coming across is, can you clarify what strategy you will be transitioning to?
Rivington manages 3 investment strategies currently: a international select strategy, a diversified international strategy, and a diversified global strategy. The Rivington International Select strategy, which is our concentrated high alpha share portfolio, is the strategy that investors will be transitioning into from the Hirayama portfolio.
Thanks, Matthias. How often does your investment strategy change, and why does that happen?
Well, the philosophy hasn't changed at all. It was really put in place in just over 10 years ago. So in 2004, we and I were asked to, with a clean sheet of paper, develop a global equity investment process. If we didn't have the kind of preconceived notions of sectors and regions and styles, how would we allocate money in such a big universe? And what struck us as a team was that companies manage their businesses based off of how they redeploy capital. They had $1 in, what can they do with that dollar in order to earn more than $1 in the future and compound that over time, yet no managers were using that to explicitly manage their money or to measure the skill of a management team or company. And so that philosophy has been in place over that entire period. What did change was initially we had identified 3 life cycle stages at that, so back in 2004, and by 2006 we had expanded that through more work into 5 life cycle stages because we saw some opportunities to get more granular. Other than that, it's really been an evolution of trying to build out our database of company research and to continually try and improve our tools, because the data, frankly, has gotten a lot better. So back in 2004, the number of financial factors that you could use for stock screening was a fraction of what's available now. And that in particular has been something that's been helpful in expanding the library, as Andy said, from which was kind of 30-ish factors back then to more than twice that now.
Great. So speaking of granularity, how do you guys get the buy list down from 100 names down to like 30 or 60 for some of the more concentrated portfolios? How do you make that decision?
So that's the final step in the process, really, in terms of portfolio construction, and we use an optimizer to assist us there. The goal of the optimizer is to maximize the portfolio's risk-adjusted return while minimizing the variance to the benchmark. So in this case, it would be ACWI ex-US. Ultimately, we use that as a tool, and it helps us to choose the right portfolio which best expresses our fundamental views. In that optimizer, there are going to be a number of constraints which are going to limit certain things like position size, number of names, and that's how you construct a portfolio, which will be select, for example, which will have a maximum of 45 names versus a diversified portfolio which can have up to 90 names.
And one short clarification question coming in from the field: are there country constraints on the portfolio?
No, there are no country constraints, and that really is redundant in the sense that we already incorporate what's a pretty sophisticated and statistical approach to portfolio construction, and that really lets you to get a lot more granular in terms of your risk analysis. Portfolios are constrained really by a tracking error range in the optimization process, and having an additional narrow country limit is actually will be completely unnecessary in that sense. You want to allow the optimizer to have the ability to give you choices to express your fundamental views in as large a way as possible to maximize expected return.
How do you guys cover the entire universe of stocks?
Well, firstly, we're really only focusing on one rated stock, so the first quintile. So the 3,000 companies is quickly whittled down to only 600 names in order for us to do work on. And the point is that these 600 names have been proven through our testing to have the highest likelihood of outperforming, and we have not only done that in back testing, but proved it over the last 10 years as working together as a team. So we don't do maintenance research on companies that are outside of the first quintile. Frankly, it's not a good use of our time, and as you've probably seen, we're very focused on improving our productivity and making sure that we have the best possible starting point to do our work. And frankly, we think that that is our biggest competitive advantage.
That's great. Thank you, Matthias. We've taken a lot of everybody's time. We really appreciate everybody tuning in to the webinar. We have one last question coming in from the field. You've talked a lot about how you segment the universe, how you get it smaller so that it's manageable from a fundamental point of view to pick the right stocks. We've talked about how we can compress that down into portfolios. We've talked a lot about, in effect, how to buy stocks. Would you give us a few words about how you sell stocks?
Sure. We have a sell discipline kind of ingrained within our investment process, and there are kind of two aspects of it. So on a kind of regular day-to-day basis, one of the strengths of using an optimizer in terms of your portfolio construction is it's constantly encouraging you to redeploy capital from those names in your portfolio that have a lower risk-adjusted return expected to those names that have the highest expected risk-adjusted returns. And that's a function of our price targets that we set for companies. So that kind of natural change in terms of the allocation portfolio, first of all, it goes very well with how we think about companies and them redeploying their own capital, but it is kind of a regular function of our investment process. And then specifically to individual ideas, we have a thesis note that we write for every investment. It's really a short two-pager which summarizes the most important points of our investment process and our evaluation. And on those, in that thesis, there are milestones, and that must be crossed in our minds for this investment to be successful. And that's where our sell discipline really comes in. If any one of those milestones is missed, we exit our position. We have another 599 companies in the first quintile to consider. So in order to keep a portfolio, particularly a select portfolio of best ideas, you need to be disciplined and make sure that only those best ideas stay in your portfolio, and then that's what these milestones really help us to do.
Thank you very much, Matthias and Chris and Andy, for explaining the Rivington process in detail. And thanks everybody on the line for giving us an opportunity to tell you about what Rivington is doing. If you have additional questions, please reach out to your representative at WHV or your normal contact at WHV and ask whatever questions you have at this point that we haven't been able to address. And with that, I think we have a compliance notification to give you, and otherwise I think we're concluded. Thank you so much for joining us.
Information provided in this webinar and any communication or transcript related to this webinar are as of the date of the initial publication, are for informational purposes only, and may not be recorded, reproduced, redirected, or distributed without the prior written permission of WHV Investments. Nothing presented in this webinar is intended to constitute investment advice, and no investment decision should be made based on the information provided. Information provided reflects the views of WHV as of the date of this webinar. Such views are subject to change without notice. Any information regarding holdings, allocations, and other characteristics are for illustrative purposes only and may not be representative of any current or future investments or allocations. This information is not a recommendation to purchase or sell a security or follow any strategy or allocation. Any forward-looking statement or forecasts are based on assumptions, and actual results may vary from any statements or forecasts. While WHV has used reasonable efforts to obtain information from reliable sources, no representations or warranties are made as to the accuracy, reliability, or completeness of third-party information presented in this webinar. It is possible to lose money by investing in securities. Past performance does not guarantee future results. Thank you for attending and have a wonderful day.